Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Power Solutions International Inc. Annual Report. Power Solutions International Inc. offers a diverse range of businesses and services that cater to various industries. The company designs, engineers, manufactures, markets, and sells engines and power systems for both domestic and international markets. One of the key areas of focus for Power Solutions International is the design and manufacture of custom-engineered integrated electrical power generation systems for standby and prime power applications. They also sell emission-certified compression ignition and spark ignition internal combustion engines, as well as fabricate power system enclosures and source electrification components. In addition to these core offerings, the company provides a wide range of mobile and stationary gensets for various applications, including emergency standby, rental, prime power, demand response, microgrid, oil and gas, data center, renewable energy resiliency, and combined heat and power. They also offer a variety of industrial equipment, such as forklifts, wood chippers, stump grinders, sweepers/industrial scrubbers, aerial lift platforms/scissor lifts, irrigation pumps, oil and gas compression, oil lifts, off-road utility vehicles, ground support equipment, ice resurfacing equipment, pump jacks, and battery packs. Furthermore, Power Solutions International provides vocational trucks and vans, school buses, transit buses, and terminal and utility tractors. The company's extensive range of products and services makes it a one-stop shop for various industries, including industrial, commercial, and residential sectors. Power Solutions International, Inc., PSIX, has experienced a remarkable surge in its stock price over the past year, with a significant increase of 92.93%. This impressive growth can be attributed to several key factors that have contributed to the company's success. One major driver behind PSIX's rising stock price is its consistent strong financial results. Throughout 2025, the company reported robust earnings and revenue growth across all quarters, with notable achievements including record-breaking first-quarter performance, second-quarter sales and profit records, and a highest-ever third-quarter sales milestone. These impressive financial results demonstrate the company's ability to adapt to changing market conditions and capitalize on emerging trends. Another significant factor contributing to PSIX's stock price surge is its strategic focus on the high-demand data center market. The company has actively worked on increasing manufacturing capacity and capabilities to meet evolving customer needs, positioning itself as a leader in this rapidly expanding sector. This strategic shift has not only driven demand for the company's products, but also enhanced its competitive position. In addition to its financial performance and market focus, PSIX has made several key announcements that have further boosted investor confidence. These include the acquisition of MTL Manufacturing and Equipment Inc., which is expected to improve vertical integration and supply chain control within the data center market. The secured $135 million long-term, committed credit facility, providing enhanced flexibility and strategic resources for future growth, and its inclusion in major stock market indexes, such as the Russell 3000 and MSCI US Small Cap Index. These developments collectively demonstrate Power Solutions International's ability to execute a successful operational turnaround and strategic positioning in high-growth markets. As a result, investor confidence has been boosted, leading to a significant increase in the company's stock price over the past year. Power Solutions International, Inc. maintains a market capitalization of $1 billion, broadly in line with the industry peer group. Power Solutions International, Inc. trades at a lower price-to-earnings ratio of 11 times and a higher price-to-book ratio of 7.74 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 80% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth for a company can be attributed to several key factors. Firstly, the expansion of heavy-duty engine product lines with Weikai America Corp has contributed significantly to revenue growth. Additionally, increased demand for generators, microgrids, and demand response equipment due to market trends has also played a crucial role. The growing demand for clean energy and alternatives to diesel power engines is another significant driver of revenue growth. Furthermore, the company's focus on expanding its product lineup and entering new markets, such as Europe, has led to increased revenue. Collaboration with Weikai, including access to its new energy, product portfolio, and R&D capabilities, has also contributed to revenue growth. The growing aftermarket sales of value-added components and increasing demand for new energy and latest market trends have also driven revenue growth. On the other hand, the primary drivers of revenue decline can be attributed to several factors. Firstly, fluctuations in customer demand, particularly in key markets such as heavy equipment, transportation, industrial, and power generation, has led to a decrease in revenue. Escalating geopolitical tensions and global supply chain disruptions have also contributed to revenue decline. Additionally, the tariff environment uncertainty and potential refunds/reimbursements have affected revenue. Rising interest rates and tightening lending standards affecting access to credit markets have also impacted revenue. Price increases in key components due to market forces, inflation, and raw material costs have led to a decrease in revenue. The difficulty in passing on cost increases to OEM customers due to competitive market conditions has also contributed to revenue decline. Overall, the company's revenue growth is driven by its ability to adapt to changing market trends and customer demands, while its revenue decline is attributed to external factors such as fluctuations in customer demand, geopolitical tensions, and economic uncertainty. The company's debt level and interest expenses have undergone significant changes over the past year. According to the report, the total debt obligations as of December 31, 2025, were $96.6 million, a notable increase from the previous year. This is also reflected in the long-term debt, which rose from $54 million in 2024 to $96,234 million in 2025. However, despite the increase in debt level, interest expenses have actually decreased significantly. In most cases, interest expenses have dropped by around 40–50% compared to the previous year. For instance, on page 30, it is mentioned that interest expenses decreased from $11,443,000 in 2024 to $6,702,000 in 2025, a decrease of $4,741,000 or 41%. Similarly, on page 58, interest expenses dropped from $12.6 million in 2024 to $7.8 million in 2025. The only instance where interest expenses increased was on page 60, where it is mentioned that the interest expense rose by 200% from $0.1 million to $0.3 million. However, this appears to be an anomaly and not representative of the overall trend. Overall, while the company's debt level has increased, its interest expenses have decreased significantly, indicating a more manageable financial situation. Management is optimistic about the company's future prospects, citing industry growth and opportunities for expansion. To capitalize on these trends, strategic investments will be made to increase global market share and drive sales growth. The company plans to improve efficiency and profitability through lean manufacturing operations and the expansion of its heavy-duty engine product line. This focus on high-return areas is expected to boost margins and profitability. In addition to operational improvements, management is committed to producing environmentally friendly products that reduce emissions. The company aims to mitigate its environmental impact by operating facilities in a sustainable manner. However, management acknowledges potential risks to the company's liquidity, including volatility in demand, supply chain constraints, and significant capital investment requirements. To address these challenges, management is focused on mitigating higher warranty costs and recruiting and retaining key employees. The company also plans to prioritize products with strong demand and high gross margins, while expanding manufacturing capacity to meet growing demand from data center markets. Overall, the company's outlook is positive, driven by qualitative factors and a long-term growth strategy with assumed growth rates and demand trends. The company's dividend policy has been a notable aspect of its financial management. According to the provided summary, the company has not paid any dividends to its shareholders. This decision suggests that the company may be prioritizing reinvestment in its business operations over distributing profits to investors. A closer look at the information reveals that the company has explicitly stated it has paid no dividends and not paid any cash dividends on common stock to date. These statements leave little room for interpretation, indicating a clear policy of retaining earnings within the company. There are concerns about inventory buildup or supply chain disruption in the company's operations. One major concern is the potential for inventory buildup if the company is unable to pass increased costs onto customers, page 12. This could lead to a surplus of inventory, which may not be sold before it becomes obsolete. Supply chain disruptions are also a significant risk, including shortages, delivery delays, or sudden cost increases that may require holding higher levels of inventory, page 13. The company's reliance on a single supplier, Weikai, for high inventory purchases, page 26, further exacerbates this concern. Additionally, the imposition of tariffs and other import/export barriers, trade and technology protection measures, transportation delays and interruptions, political and economic instability, acts of war, labor unrest, natural disasters, and public health concerns may cause supply chain disruptions, page 19. The company's financial statements also indicate potential risks related to inventory buildup. The tariff costs associated with products in the supply chain, decrease in cash provided by operating activities due to purchases of inventory, $69.6 million, and higher sales volume and operational growth led to increased working capital needs, page 31. Furthermore, the significant increase in raw materials inventory and finished goods inventory from 2024 to 2025, page 50, indicates potential risks related to inventory buildup. Overall, these concerns highlight the need for the company to carefully manage its inventory levels and supply chain to mitigate potential disruptions. That concludes the financial summary for Power Solutions International Inc. Feel free to comment below, and I will be happy to answer them when possible.